The collar is powerful because if you get into a stock that drops a lot, it's going to keep your cost basis in line that you can easily recover. You're not going to be up initially when you do a collar if it drops a lot. But the key to doing a collar is that you're going to be able to limit and define your risk to the downside. You can decide if you want to lose 1%, 2%, 5%, 10%, 20%, whatever it may be. You can define it by where you buy that put at. Let's look at IBIT as an example here. It's going for about $53 a share, and I'm going to go out to 25 days for this example. And let's break down each component of the collar strategy. It's three components of the collar strategy. The first component is the buying of 100 shares. So if we go up here on the TastyTrade platform and even on the Thinkorswim platform, if you go at the top and you click on the ask, that's where you're going to be buying the shares from. So if you click on here, it brings down at the bottom 100 shares. 100 shares is considered a standard lot in the stock market world, right? It's a standard lot. Anything that's more than that, that's not in divisible of 100 shares, is considered non-standard. So something more or less. It has to be 100, 200, 300, 400, and so forth. That's considered a standard lot. When you buy shares, it's clear what you want to happen. You want it to go up. It's no mistaking that. If you buy shares and it goes up, you're going to make some money. You're going to make $1 per share for every dollar move that it goes up. It's also clear that you do not want it to go down. If it goes down, then you can lose $1 per share for every dollar move down until it gets to zero. So it shouldn't be any ambiguity for us as what do we want to happen if we simply buy shares. If we buy a standard lot of shares, we want it to go up. We don't want it to stay the same. We obviously don't want it to go down. We want it to go up. All right. So we have the shares. We have this 100 shares, and that is clear. We want it to go up. We don't want it to go down. The second component of a collar strategy is what is called selling of a call. And it's commonly referred to as a covered call. And the reason why it's called a covered call is because you have 100 shares. If you sold a call by itself, let's just say we sold this call at the 55 strike, this is called an uncovered or a naked call. When you sell a naked call, you have an obligation. It's back to the basics of options, okay? We're trying to understand the collar strategy through the lens of the basics of options. Or we're trying to understand the basics of options through the lens of the collar strategy. When you sell a call, you have an obligation to sell shares to the buyer of the call. So once again, the seller of a call has an obligation to sell shares to the buyer of the call at the strike price that you sell the call for. When you sell an uncovered or commonly known as a naked call, you theoretically have unlimited risk to the upside. A market can't go theoretically forever to the downside. Once you get to zero, that's done. But to the upside, you can go technically forever. It doesn't work that way, but it can feel that way if a stock jumps up in a significant manner. It can definitely feel that way, but it's not going to go up into perpetuity. But that's not what I really want you to understand here. What I want you to understand is just the concept of the basics of options when you sell a call. You are required to provide shares to the buyer if they exercise their right. And technically, they have the ability to exercise their right at any time. Most of the time, it's only going to happen if it's in the money, but they do technically have the ability to exercise their right at any time. If you have the shares already, then you don't have to go out into the open market and buy the shares and then provide it to the purchaser of the call. You already have the shares. So it's considered a conservative strategy because it's not a naked call. It's a covered call because you have the shares already. And it looks something very similar to this. You have the 100 shares, and then you sell the call against your shares. I like to tell people that this is the landlord strategy. The 100 shares that you have, which we want those to go up, as we talked about, if we just had the shares, those shares are an asset. It's like a house that you can rent out. You can Airbnb it. You can give somebody technically the ability to rent to own. If you bought your house at 53, in this case the shares at 53, and it went up to 55, you would get appreciation of those 2 points, which in options world is $200. Plus, you would get the monies someone paid you for that call to have the right to purchase at 55, which is basically another $200. So in this example here, if you bought it at 53, it's not trading at 53, but I'm doing this for easy math, and someone paid you $200 for the call, then in this example, the most you can make, if it went all the way up to 55 and went past that, the most you can make is the $400 in the next 25 days. And this can be set up for any time frame, darn near. The shares you own is bullish. They're an asset that you can rent out. The call that you sell gives you the obligation to provide shares or sell shares to the buyer of the call. If you do not have the shares, then it's considered a naked or uncovered call. If you have the shares, as in this example we're showing right now, then it's called a covered call. You have the asset, you have it in your possession, it's covered. You don't have to go get it to live up to your obligation, to meet your obligation, I should say. The covered call has a limit to how much you can make to the upside. You are capping your upside. The same if you had a house and you gave someone the option to rent to own. That that rent to own part or that owning part will have to be met at a certain level. And if the person meets that level and exercises that option, then that is the limit you can make. That is exactly what is happening with options with the covered call. It's a limit to what you can make. And that's at the call strike. When you're doing a covered call, you still have risks all the way to zero. It's less than the risk that the person has if they just outright buy the shares because they're not getting that $200 or so for the call that they're selling. The monies that you receive when you sell the call acts as a buffer. It acts as a hedge at the very least to the downside. But you still have risk to zero. In this case, you have a little over $5,100 in risk if this IBIT went to zero. The covered call has risk to zero. Whatever you're trading can go to zero, most likely won't, especially an index, but it can. So technically you have risk still all the way to zero. And some of you have done covered calls in the past, especially during the 2022 bear market, and you felt the pain and clearly understand what can happen to covered calls if the underlying drops too much. And if you started your covered call strategy trading in 2022, at least in the beginning of 2022, you probably thought the covered call is a poor strategy. It doesn't work. That is not the case. It's a fantastic strategy, but it's a bullish strategy. If the market is staying in a range or going up, this covered call strategy is going to be excellent. But if it's going down, and especially a lot, this covered call strategy is going to hurt, just like any other bullish strategy. The covered call is bullish. If you have 100 shares, that equals 100 deltas. Each share equals 1 delta. When you sell a call, that equals bear. It's a bear strategy that equals the deltas that you sell it at. So if you take the 100 and subtract 44 from it, you're going to get this 56 down here of positive deltas. TastyTrade is an excellent prop firm because it's telling you how much deltas you have when you do this trade, this covered call. You're still bullish. 56 positive deltas. That means you want it to go up. If you have positive deltas, you want it to go up. Make no mistake about it. So what I want you to get out of this part, and if you don't understand it, it's feel free to unmute your mic. What I want you to get out of this part is that the covered call has a limit to the upside. You have a cap to the upside. It's bullish, and you still have risk to zero. Covered call is a good strategy. It's less bullish than just owning the shares. That's why you have less risk. If you just buy the shares right now, you have 100 positive deltas. If you do this covered call right now, you have 56 positive deltas, almost half the amount of delta. So that means you have half the amount of risk of someone who is just buying the shares outright. But you want it to go up and you have risk all the way to zero. Now, if you get these two components, the buying of the shares and then the selling of the call when you have the shares, which creates the covered call. If you understand this part now, then the third component is the most difficult part to understand for as I've been gathering from members. But you just have to segregate each part. You have to separate each part to be able to understand it. So the third and last part of a collar strategy, which we're trying to get to here, is the buying of the put. When you're setting up a collar strategy, you want to buy a put the super majority of the time, not 100% of the time, but darn near 100% of the time. You want to buy the put for less than what you're receiving from the call. So if you're receiving $195, $196 for selling the call, then you want to buy a put for less than that. So in this case, we can buy a put at the 52.5 here if we wanted to, or the 52. Let's just do the 52 for example purposes. If we buy this put at the 52 strike, we're going to still have about $24 in extrinsic. So if we disregard the shares and we just sold this call and bought this put, we would have $24 in credit. Someone would pay us $24 in credit, okay? A net credit for just the shares, excuse me, just the options. But we have the shares attached to it. So it's going to still be an overall net debit because the shares you're buying. But that's fine, and I'll talk about that more in a second. But let's break down this put, the basics of a put. If you buy a put, you have a right. You do not have an obligation. You have a right to sell. This is the basics of options, everyone. If you buy a put, you have the right to sell at the strike price that you buy the put at. When you buy in a put, it is bearish. You want it to go down. So if you bought a put by itself and the stock went to zero, you would have the right to sell at the 150 at the 52 strike price here. You would have the right to sell. So you don't have a total loss. On the contrary, you have a very small loss depending on how you structure it. So in this example, we talked about if you just did a covered call and if you just bought the shares, you have risk all the way to zero. If you collar this off by buying the put, in this example, your risk is only $129. It's fluctuating, $129, $130. That's the most you can lose over the next 25 days. Even if IBIT or any underlining you're doing it on went to zero. That is the most you can lose because you have the right to sell your 100 shares, because each option equals 100 shares, as we talked about, a standard lot. You have the right to sell your shares at the 52 strike. So
Right.
just like you capping your upside on the call side, you're limiting your downside or capping your risk to the downside with this put. When you have a right, for example, this put, you have a right to sell it at 52. Well, if it expires in the money, You're telling the broker's firm, if you allow it to expire in the money, you're telling the broker's firm that you want to exercise your right. Automatically, it's going to happen because that is the signal. You don't have to, in the past, years ago, you had to call the broker's firm and still tell them you wanted to exercise your right. But to make it clear and to simplify the process, it's literally if it expires in the money, you're telling the broker's firm that you want to exercise your right. So if you do not want to exercise your right and it's in the money, you just exit the trade before expiration. But you do have the right, and it will happen if it's in the money at expiration. It's not going to happen before unless you exercise your right before. And the way you do that is contact the broker. Most people don't exercise their rights, or if they did, it's going to be automatically done because it's in the money at expiration. You want to know that detail because that's the basis of options. But what I want you to get from this is that when you do a collar strategy, you have a cap to the upside. You have a limit to how much you can make to the upside because of the call that you sell. And you also have a limit to how much you can lose to the downside based on the put that you purchase, that you buy. You're collaring off your risk to the upside and you're collaring off your risk to the downside. Or maybe I should say you're collaring off your potential to the upside and your risk to the downside. Okay? That's a better way to put it. The collar is powerful because if you get into a stock that drops a lot, it's going to keep your cost basis in line that you can easily recover. You're not going to be up initially when you do a collar if it drops a lot. But the key to doing a collar is that you're going to be able to limit and define your risk to the downside. You can decide if you want to lose 1%, 2%, 5%, 10%, 20%, whatever it may be. You can define it by where you buy that put at. But a collar strategy is still bullish. We said the shares are bullish. When you buy the shares, 100 shares is 100 deltas. That's bullish deltas. When you sell the call, right? Let's say you sell the call at a 44 delta. And if you buy the put, that's also bearish deltas. Let's say it's 38. And so if you did all the math there, TastyTrade is giving it to you here. A little over 18 long deltas still. So you have a lot less deltas than buying the shares by themselves or selling the covered call by itself. But it's still bullish. You still want it to go up. The collar strategy is a bullish strategy, just like buying shares or doing the covered call. It's just giving you more protection to the downside. So if a stock drops a ton, and this happened, I'm going to use Gordon as an example because he just presented a question or a statement. He had some shares, a lot of shares in NVIDIA. And NVIDIA dropped a ton about 2 weeks ago or so. But he lost an insignificant amount because he had his shares collared off. I know Charles, another member, had some shares in NVIDIA, and he had a put at the 146 strike. And NVIDIA went down to the 115, 118, something like that it went down to. Well, he wasn't stressed. He was able to sleep at night. He was able to just, look at the situation and say, okay, I'm fine. He stopped losing at a manageable amount. This is why the collar is an excellent strategy in an environment where we're at all-time highs and we have uncertainty of how the market is going to respond to certain policies. The market could respond going up like it has been throughout this incredible bull market. You can argue since 2008, or it could go down. And so we need to be more vigilant and care more about the downside because the upside will take care of itself. So the collar strategy is a great one there because you're still going to get some upside. It's still a bullish strategy, and it can be significantly more bullish depending on how you want to structure it. So for example, if I wanted to sell this call at the tail end of the expected move and move this put to a little further down, as I say down here to the 46 strike, well now I have 63 deltas instead of 18 on this collar strategy. Yeah, I can lose more. Instead of 130, now I can lose almost 700. but I can also make more. You have to structure it based on your risk tolerance. Sometimes, or even a lot of times, it makes sense to have a wide collar so you can let things fluctuate if it's going to be a core position that you're going to be in for a long time. Just keep repositioning the collar every 30 days or so. That's perfectly fine to do. Or if your risk tolerance is a lot tighter, you can do something similar to what I just showed, that you have very little risk over a time frame. But it's understanding the three components and why would you do each one. It's a place for just buying the shares. It's a place for just doing the collar. And obviously it's a place for just doing the covered call. What I'm advocating is that right now the collar is the more responsible, the more vigilant strategy to do.